Austin. This is Randy White, your local Austin realtor. We're going to do our July market report with national numbers. I will be back next week to do a more localized Austin version for a market report. So, without further ado, let's kick it.
Well, I'm going down to Austin, Texas. I'm going down to save my soul.
Let's jump on in and talk about the economic slowdown. Who here is tired of talking about a recession? Me. Let's take a look at something that was written in the Wall Street Journal. 3/4 of global CEOs say we are in a recession or will be in the next 12 to 18 months, according to a new survey. Super. So what can we control when entering into a recession? Nothing. But what we can do is be as knowledgeable as possible of what is going on around us. And so that's what I want to focus on today. So I'm going to show you guys historically how a recession ties into my industry, the housing market. I want to start here with a quote from Mortgage Specialist. Throughout history, during a recessionary period, interest rates go up at the beginning of the recession. But in order to come out of a recession, interest rates are lowered to stimulate the economy moving forward. Historically, we have seen a repeated uptick in interest rates followed by lowered interest rates. So I've got a few graphs that are going to come up and help crystallize this thought of what has happened in the past during other recessionary times. Now, that is not indicative of what is going to certainly be happening for us in the future. I mean, if anything has really been brought to light for us here in the last couple of years is that nothing is going as expected. My first graph is showing us the interest rates as the blue line, and then the yellow boxes are recessionary periods. So you can visually see that each time we enter into a recessionary period, the blue interest rate line tends to go down. Now I also have a table version of this to break it down even further. In this very cool table, we're going to go all the way back to the early 80s, and it is going to tell us all the important pieces, right? So when did that recession happen? How long did it last for? What was the starting interest rate? And what was the ending interest rate? And you can see that one thing that all of these recessionary periods have in common is that in each instance, the mortgage rates fell. So I bring this up not to say that every recession going forward is going to go exactly like this. I'm not saying that. I don't have a crystal ball. I can't be sure of anything. But what I can say is that when somebody asks me, how does a recession affect the real estate business? I'm going to say, well, in the past, it's always caused the interest rates to go lower. And more specifically, in the past 5 recessions, the interest percentage points have dropped 1.8%. From the peak of the recession down to the trough. And also, they continue to fall even after that because it takes a while for things to turn around, even after the recession is technically over. So I want to take a pause here and kind of review an important piece. So most of you guys know that all the work the Fed is doing is trying to tame inflation, right? So they raise the Fed fund rate to slow down inflation because if we aren't worried about enough crap, we're also worried about the fact that our milk and gas are too expensive. So they are trying to engineer this soft landing. And if they don't engineer the soft landing, then we end up in a recession. Well, the data is in, people. And what it's showing us is that we are either already in a recession or we're quickly approaching it. And so if the Fed doesn't engineer this soft landing, then what do they know? Well, I'll tell you. They know that the U.S. housing economy has a tremendous impact on how the U.S. economy does. So the U.S. economy will not recover until housing leads the way out. And so that is the reason why you see these cyclical events happen when it comes to an economic slowdown. So let's dive in even more on this relationship between recessionary periods and the housing market. So we just got done taking a look at the correlation between the recessionary periods and specifically interest rates. But what about housing prices? So I've got a graph here that is titled, "A recession does not equal a housing crisis." And it is going all the way back to the 80s again. And we are seeing that 4 out of the 6 times that we are in a recession, homes appreciated. 2 times they fell. Once marginally in the early 90s, and then the other time was in fabulous 2008. So I think this is a perfect way to sort of conclude this segment of my video, which is talking about the relationship between recessions and the real estate industry. Because we are once again reminded of the, ferocious battle we went into with 2008. And what it really has done is made the word recession take on a new meaning for people that were involved in that. Because what was at the epicenter of 2008 was the real estate industry and the housing market. So to be personally affected or hurt during that time, or to have known family members and watched them go through just the horrific scene that we all, watched unfold, makes us feel like a recession. What's going to happen to my house? But as we know, and as I have hopefully shared and educated with all of you in my previous videos, that recession was specifically related to the housing market for many reasons that just do not exist today. Now let's move on to talking about inventory, right? So that was just the biggest topic I talked about for the last 2 years. Was there is zero inventory out there and it's pretty hopeless for buyers. Well, that has not been the case for the last couple of months now. I've had a really great time with my buyers while we have had options in this market. So I want to talk about some key trends that we're seeing on the market, and then we'll talk about how that is impacting inventory. So the first one I want to mention is offers received. So we're seeing that number decline. It peaked around 5.5 offers in April, and then it dropped to 5, and now the latest number that was released in June is at about 4.2. So, what this means is that rising mortgage interest rates are really softening the demand. But if you think about it, 4.2 offers per home sold is still, pretty far above the pre-pandemic norm. So definitely still in a competitive market, but we are witnessing the softening or the moderation of that. So we're also seeing that offers coming in over asking is also declining. So a month ago, 61% of offers turned in were over asking, and now that number has come down to 55% of homes sold were over asking. But if you think about that one too, that's still more than half the homes sold for over asking. So softening, moderation, but definitely not a huge decline. Another thing that we're seeing is that sales are slowing down. So with sales slowing down, I definitely want to spend some time breaking this down for you guys with some visuals, sharing all the factors that come into play and what does that exactly mean for inventory. Certainly means a lot more options for buyers, but what else does it mean? Let's start off with this quote from Mark Fleming, the chief economist of First American. There has been a pickup in the inventory that we've seen recently, but it's not from a big increase in new listings, but rather a slowdown in the pace of sales. And remember that month supply measures the inventory of sale relative to the pace of sales. Same inventory, fewer sales means more months of supply. So let's take a deeper look at what that means. We know the month of supply has been, the months of supply of inventory has been increasing. So we were at a record low in January with 1.6 months of inventory. And then we have increased to 2.6 months of inventory. Now that's not a huge increase, but it certainly is more options for buyers. And then remember that a balanced market is all the way up to 6 months. So we're certainly not out of the woods here, people. We haven't been at 6 months of supply since 2012. But we are moving in the right direction towards that balanced market. So what do those numbers look like with new inventory coming in? So I have a graph here from Realtor.com, and the green bars are showing 2021 numbers, and the blue lines are showing 2022 numbers. And you can see that just from new listing accounts, so new home sales arriving on the market, that has slightly started to increase as of April and May. So actual homes coming to market this year compared to last year has slightly risen. So another thing that's happening though is going to relate to what we were hearing from Mark Fleming's quote earlier, which is just that the pace of sales is slowing. So I got a graph here from NAR that shows the seasonally adjusted annual rate for existing home sales, and that green bar shows that if we continue at the pace that we are currently at in May of 2022, we are projected to finish off the year at 5.4 million sales. So, you know, when you look over at those blue bars there for 2020 and 2021, you're thinking, well, that stinks. You know, that sounds like we're doing terrible. And where's all the home sales? But I need you to remember that 2020 and 2021 was a total anomaly, and we had an outrageous amount of home sales, like record breaking in all directions. So just wipe those off the table and let's put those in our past and just say, well, that was wacky, just like so many other things in those years. And what I want you to pay attention to is those boring gray bars over there. Now, in fact, 2018 and 2019 were really great years for the housing market. So although the pace of sales is slowing down compared to what we've been used to the last 2 strange years, when it comes to pre-pandemic life, you know, we're just going back to that and we're matching up and actually maybe even projected to do slightly better than what was previously considered to be excellent real estate years. So in summary of this data that I have shown you about some new inventory coming in, but the pace of sales slowing down, I've got a quote here from Lawrence Yun, the chief economist at NAR. Home sales have essentially returned to the levels seen in 2019 prior to the pandemic after 2 years of gangbuster performance. I then have another quote for you, and this is coming from Danielle Hale, chief economist at Realtor.com. Active inventory continued to grow, rising 21% above 1 year ago. In other words, we're starting to add more options, but the market needs even more before home shoppers have a selection that's roughly equivalent to the pre-pandemic housing market. So in summary, we got more options coming on the market for buyers, but there are still more buyers than sellers. Okay, so it's going to continue to still put a slight pressure, upward pressure on prices, because that's just how supply and demand works. Now, I know that that's confusing for people out there because you're seeing all these price decreases happening, but the price decreases are not necessarily home values depreciating. What that is home sellers and listing agents having a faulty pricing strategy because just 5 or 6 months ago, whenever a seller and a listing agent would meet, a seller is given a range of what they can list their home at. And you could honestly, at that time, when the market was just bananas for sellers, you could list right at the top of that range and the market would just gobble it up and probably shoot it on past that and get 40 offers on it and, have 150% list to sale price ratio. But that's not the market we're in anymore, right? So everybody is pricing at the top of their range and the demand is just not there anymore. So they're having to decrease their price and come back to the middle of the price range recommendation, or maybe more at the lower end of the price range. And in my opinion, I kind of always lean for go with the lower end of the price range so that the seller can pick from a couple of offers, get some competition going, and be able to have favorable terms within that contract. Because it's not just all about price, people. So that's what you're seeing with all those price decreases, is just pricing strategies being a little late to adjust to how much the market changed in the last couple of months. All right, so what does that mean for the rest of the year? Well, they thought they knew, but they didn't. So Realtor.com has released a reforecast of what inventory should look like for 2022. At the beginning, they thought it was going to be an increase of 0.3%. Cute. But they've shoved that out of the way and they said, whoops, never mind. We actually forecast that for the remainder of the year, we're going to have a whopping 15% increase in inventory. And that's going to have everything to do that we just got done talking about, which is the slowing of home sales, that slower pace of home sales, and that slight uptick of inventory coming into the market. More options for buyers. Let's kick it back over to Mark Fleming, chief economist at First American. We should start to see less competition, fewer bidding wars, and therefore less upward price pressure. In fact, a simple analysis shows that a 1-month increase in the month's supply results in a 3% decline in annualized house price growth. Growth is a key word, not value or price, but growth. And our preliminary house price index is already showing moderation in house prices in April. So we've got a softening of demand, more listings coming to market, creating a slower pace of sales. So that's going to help lessen the tug between buyer demand and supply, which we desperately needed anyway. And what that means is going to be less upward pressure on those prices, but prices are still going to increase because the buyer demand is still higher than the supply at this time. God, I just love economics, don't you? All right, guys, that's gonna be the conclusion of my July market report. These were nationwide numbers. Tune in next week if you want my more Austin-specific market report. Please like and subscribe my channel. Comment on this video. Let me know what you thought of it. It helps YouTube know that I'm giving you guys good stuff, which I know that I am. And if you're gonna buy or sell in Austin, Texas, please contact me. All of my information is below. Thank you for watching my channel, my videos, and I'll see you guys next week. Thanks.
I'm going down to Austin, Texas. I'm going down to save my soul.